Welcome back, everybody. And extremely happy to be joined on this panel by several industry practitioners. And the topic is quite broad, Leadership Speaks. We're going to cover a number of different items that we hope are of interest and get hopefully a variety of perspectives and keep it interesting. We'll start with just having each of our panelists introduce themselves. So start with David.
David Barse. I'm the CEO of Third Avenue Management here in New York. We're effectively a deep value shop, long only value equity, although we've got our history in distressed investing. Our firm was founded by Marty Whitman about 25 years ago, and we manage about $16 billion today.
My name is Mark Carhart, and I'm a recovering academic. The past 6 months, I've actually been unaffiliated, traveling the country with my two daughters and my wife in an Airstream trailer. So please don't expect any up-to-the-minute insights from me. But prior to that, I was the co-CIO of the quant business at GSAM and enjoyed 12 great years there, except maybe for August '07, which was a little rough.
I'm Mike Hennessey, Managing Director of Investments for Morgan Creek, which is essentially it's a fund-to-fund, $9 billion fund-to-fund, but it's kind of taking the endowment model and splitting that into the different sleeves or silos, as we call them, in a way to better customize asset allocation for institutions.
Good morning. My name is Jaeson Dubrovay, and I'm Senior Strategist at NEPC. We're a general consultant. We advise on about $300 billion. I head up the hedge fund group. We've got about $22 billion in both hedge funds and fund-to-funds that our clients are invested in.
Thank you, guys. And I'm Joel Molinari with Capital IQ. So we're going to start with a pretty broad topic. Simply perhaps tell us, what have we learned over the past 12 months? Or what have each of you learned, perhaps, over the past 12 months? And we'll start with David.
I guess being the only true buy-side guy on the panel right now, although as I told Mark before, my goal in life is to become him, a retired partner. If you look at his badge, retired partner. We should all become retired partners. Our lesson learned was really staying disciplined to our investment philosophy. We write a lot about what we do at Third Avenue and the principles of investing that we follow. One of the most important things is the strength of the balance sheet of a company that we invest in. I think that we all learned a lot last year about what happened with firms and their balance sheets and their needs to access capital when capital was not available, and how important that criteria for investing is. And I think it's really firmed up our discipline as we moved out and through this cycle to stick to that knitting and that important discipline point about investing. And we emphasize it in everything that we do right now. So if there was a lesson learned, it's probably being really true to that. First of all, strength of a balance sheet, and second of all, access to capital. If a company needs access to capital to survive, we're gonna probably run away from that kind of business, irrespective of what kind of cycle we're in.
David, when you retire, I'll lend you my trailer, but good luck parking it in New York City.
Yeah.
What I think we've learned are really three key issues. One is the broader topic of liquidity, transparency, and fees. I use the acronym LTF, and a lot of focus on what is the appropriate liquidity for hedge funds, particularly, but really for all commingled vehicles. What is the appropriate transparency level, depending on the strategy, and how should fees be structured? So I think those are critical issues that everyone's talking about. In my opinion, there have been a number of cases where the liquidity, transparency, and fees were not appropriate for the kind of investment. Plenty of cases where they were. The second thing I think we've learned a lot about is the importance of operational quality in an asset manager. Clearly, there are things like valuation or counterparty management, which are always relevant, but particularly in a crisis, it becomes that much more apparent. I don't think the industry does a good enough job actually rating operational quality of money managers, although there's some sense out there of which managers do better or worse. But it seems to me that's been a critical development. I think we should see more of that in terms of rating and trying to verify the quality of operations of investment managers. And the last thing is what I call beta crowding. I think there's always been embedded beta in alternative products. I think we've learned from seeing all of the major market moves how much beta is embedded in a lot of alternative products. And I suspect that over the next 5 to 10 years, you'll see a lot more development of exotic beta type products, which really try to take the beta out of alternatives and deliver it more directly in a more transparent fashion. So in my opinion, those are the three biggest issues that have arisen from the last 12 months.
Thank you. Michael?
Well, I feel sorry for people that if they came into this industry in 2003, for 5 years, I don't think they learned much, or maybe even the wrong things. The last 2 years have been the most incredible learning experience for any of us. A lot of the old tenets were heightened, were really made salient in this environment, which is, echoing some of these. Liquidity, look, having liquidity has normally been a drag on anyone's portfolio's returns for a long time. And this emphasis on short-term performance during this great, 2003, 2008 bull market would be, you would have been fired if you had too much liquidity. But liquidity always rises to its greatest value when it's most needed, obviously, in such a crisis as we had last year. So the big lesson is have that liquidity, have the long-term investors that understand, that liquidity is a good thing, having a certain amount, because when that time comes, then you can be opportunistic, and the illiquidity premiums are at their highest. Kind of connected with this, obviously, if here another, risk management, but it's absolutely true. Again, risk management will be a drag on your returns during these bull markets. So if you had really great risk management and you had, ample liquidity in your portfolio, you would have come out way ahead at the end of the day. But in that bull market, you probably would have been terminated or complained about. So have risk management. The biggest new thing we learned last 2 years is there's a risk that we hadn't encountered or hadn't counted upon, which was government risk, government intervention risk. What is the government going to do? You could have nailed, as I think we did last year, being short corporate credit and the various interventions and short financials, which is the epicenter of short credit, and you could have had the rug pulled out from under you. So always expect your risk management the bullet that you don't see. It's worth protecting yourself, not overprotecting yourself, obviously. You don't want to give up too much. We're in the business of taking risk, but try to know what you don't know.
Yeah, I'm going to, I agree with a lot of these things. The one thing I would say, and I'm a recovering CPA, so hearing it from me, probably makes a lot of sense. You have to verify what the managers tell you. So I've got 3 points. The first one is verify. In fact, a study just came out. It was conducted between 2003 and 2008 by the Stern School of Business. And on 42% of due diligence reports, they either found a noted verification problems or misinterpretations or inconsistencies. And I've been around the block a little bit. I've been investing in hedge funds since 1990. I've seen a lot, and I still see a lot of people taking managers at their word. I think you should, but you should also try to triangulate, and I don't think we've done in the industry a good job of that as we might have witnessed Madoff. Second thing is understand the manager's book and what embedded bets you might have in there. For example, I don't know if a lot of the people in the Bear Stearns portfolios knew what their embedded bets were. And I'm sure that's in a lot of different things. Again, going back to Madoff, I'm sure a lot of people had no idea what he was doing. So you just have to understand the embedded bets and the book, in the book, and does it make sense? Third thing is to, and this is from my Arthur Anderson days, understand the movement of cash from cradle to grave, and just make sure you understand who can move money, where they can move money. I'm sorry to take such an operational approach, but all the juicy stuff was taken earlier. But those are the things I would look at.
Thank you. And actually, I just want to perhaps follow up briefly on one of the things that Mark